and where are they going? The East Coast is migrating into Florida, migrating into Nashville, and New York and Florida have always had a great relationship. And then the California and the Illinois of the world migrating into Texas. And if you look at the economies at a macro level of, Illinois, California, and New York, these are bankrupt economies. They have, large, top line revenue, if you would, but they don't have any money. We operated a $12 billion surplus and have no state income taxes, in a fully diversified economy. And so it's no accident that they're coming in here, and from a geographic standpoint, being right in the center of the United States. Again, the confluence of all these events are leading to something that we'll look back 30 years from now and see something really, really special that, that our investors will benefit from.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grinzik, and with me, as always, is John Cohen. How are we doing, bud?
We're doing good. It's been a week coming out of Memorial Day weekend. Had a great weekend. The sports world for myself has been getting beat up a little bit as a Yankee fan and a Knicks fan, but be that as it may, we are bigger and better things, right? Sports are just a little piece of it.
Yeah, we're all Knicks fans are crazy optimistic going into the postseason, and now we're kind of getting our asses handed to us a little bit. So it's kind of a nice little plummet back down to planet Earth, right?
Exactly. It was Don's son was in the office and we were talking about it, and he's like, "I'm gonna cry if we lose." I'm like, "Listen, but you're young.
You happy you made it?"
We used to speak about it all the time in the office. I mean, listen, at the end of the day, as a Knicks fan for 30 years, 34 years, it's been rough. So I said, this is the Knicks. This is the definition of what we've been for, but we're here where we seem to be a little bit better. But other than that, it was a rough sports weekend for me as a Yankee fan also. But other than that, I got no complaints.
Yeah, I can't comment on anything to do with baseball because I literally don't give it a single second of my awareness, but you can keep us all updated. So it sounds like it hasn't been going well.
No, baseball's been rough to watch just as a sport, as a former baseball player. It's very difficult, and there's a whole nother side of me. It would take me decades to talk about how frustrating it is watching this new baseball that everybody plays where, you just strike out, don't even think of putting the ball in play. I mean, it's ugly, but be that as it may. And as a diehard Yankee fan, that's everything basically. It's even worse. So.
I hear you. Well, John, we'll have to get you to start a whole new podcast just talking about the Yankees so you can get your frustrations out. But in today's episode, I'm happy to have our guest on because I think he's going to have some really great stuff to talk about, tons of experience, tons of expertise. So excited to have him on. So with that being said, Ari, thank you so much for joining us.
Hey, thanks for having me.
Yeah, absolutely. So kick us off. Give us a few minutes just on, your background, your journey, what you do, all that great stuff.
Sure. So based at Austin, Texas. I'm an attorney by trade. Started in the real estate investment business when I was in law school. Used a $3,000 loan and my scholarship money to get the business started, building single family homes. Was kind of delivered pizzas through college, flipped burgers all through high school, and kind of grinded my way up. To where we are today. We're in Austin. We've invested in 38 cities, 12 states, 7 asset classes. We've invested agnostically. Our investors are mostly public pension funds, family offices, RIAs, et cetera. And so currently we have 7 projects set to break ground this year, actually, 1 in Phoenix, and the rest are kind of within the Austin MSA itself, from industrial to master plan developments. We're doing a build for rent project just south of Austin in Kyle, Texas. And we've been having a lot of fun kind of doing it, but we've assets are in the hundreds of millions. And, once we've fully developed, and a lot of that is land. And so once we've kind of developed the stuff that we have, it'll be significantly higher, but we're having a lot of fun doing what we're doing.
That's awesome. So do you guys own a lot of land that is not currently going through any sort of like development phase? You guys are just kind of sitting on it?
No, absolutely not. No, every piece of land that we own is in some phase of whether finishing up entitlements, permitting, or on the way to breaking ground. Like, no, we don't sit on land like that. The carrying costs are just, they're tough.
Sure.
So if it's a small piece of your portfolio in a big fund or something like that, there could be a reason to land bank. But we're usually looking for either, if we're sitting on land, it's a covered land play. So there's some sort of cash flow element. A lot of the multifamily that we bought, that's, kind of vintage, older product that we've renovated, brought up to rent, brought up the rents, et cetera. Really, we're always looking at the land, right? We're always looking at post-development plays, and there's just a series of ways that we look at these assets. Kind of phase one would be renovation, using bridge financing to get them to a place, refinance them into Fannie Mae or Freddie Mac, and then looking to re-entitle the properties that have the re-entitlement possibility, and then tear them down, develop them later in the future. But we're very patient capital, always, very, very long term. With that said, kind of the longer term that I look, seems like those are the properties that end up selling the quickest. So it's kind of a little bit paradoxical, but yeah.
Gotcha. So I'm actually curious, because I've heard of covered land plays when it's like, you have an industrial site or a mobile home park or something like that. I've very rarely heard of a multifamily property being a covered land play in the future. Are you just knocking it down and building more units for multifamily? Or are you converting it to a new type of asset class? How does that typically work?
Yeah, I mean, it's something that we've done, so in Austin, where I'm born and raised, where we're headquartered, I mean, the city is just booming, right? I mean, everybody knows that. And, being an Austin native, we've kind of had the inside baseball to talk a little, to kind of, wordplay a little bit. I don't really watch sports that much either, unless there are investors. We have a bunch of, athletes, celebrities, singers, along with, of course, the bulk of the money being institutional. But I watch my friends when they're playing. I'm watching. Other than that, I really don't watch sports. So in Austin, you have real geographic barriers, and Austin is a town on steroids, right? You look at Dallas or Houston or some of these larger metroplexes, even Phoenix, they're very expansive. They're sprawled metroplexes, so you can really keep going. Austin doesn't have that. So if you keep going south, you hit San Antonio, you go north a couple hours and you kind of hit Dallas. But if you were to go to west, you hit the hill country, which is very difficult to build in. There's a lot of water, which really drives supply and demand. So being able to have large parcels of land of, 2, 3, 4, 5, 6 acres, a lot of these older apartment complexes that might not have as many units are on these larger parcels of land. So as the city begins to gentrify, and I hate that word, but it's really the truth in a lot of areas that it's gentrifying. You can pick up these apartment complexes that, are very low rents, and purchase them obviously as multifamily, as a phase one, increase the rents, renovate them, and let them cash flow. And then you have the luxury of time. So once you've kind of gone through the bridge, increase the rents, you put them into Fannie, you have 10 to 15 years of low financing, a cash flowing asset, and it gives the land time to appreciate. And so you can go in and go through your entitlement process, which is pretty tough in Austin. But once it's done, the plan could be a mixed use development, could be more multifamily, which I love. Obviously, if you do that and you have time, you can have the benefit of HUD, and right now HUD is financing at, I don't know, 1.6% at, 83% of the appraised land value. So the way that land prices in Austin are swelling, and of course this doesn't work in every market, but in Austin, it can be quite accretive. So it's not something we're in a rush to do, because the multi makes sense, even, just papers on its own as multi. But the plan is down the road to bulldoze those properties and contribute the land and be able to have, a large Class A portfolio from stuff that we bought many years before.
So do you look at it, when you do that, do you look at it as, hey, my all-in basis will be X per door today. And I think that I'll be buying land at that price in 5, 7, 10, 15 years from now. And then once that happens, we've been cash flowing X% a year. We refied out our money or part of our money, and it'll make sense like that in the future. So that eventually my cost today will catch up to what land costs will be in the future, or very close.
Well, I mean, look, I mean, there's yes and no. I mean, it's a case by case basis. A lot of times when we do these underwriting, I'll underwrite it as a land acquisition just on its face, and we'll just run a model around where we think that land values would be going if there was no multi. So we just bought it as land, and clearly you're buying at a higher value because there's existing assets there. But the way that pricing is escalating in this market, within 5 to 7 years from the time of acquisition, you're looking at a multiple on land basis. I mean, it was, I think 6-7 years ago that price per foot in downtown Austin was around $300 a foot. It's at $2,000 now. I mean, these are astronomical shifts. You're watching systemic migration shifts and all the stuff that you see of going on in Austin and throughout Texas. So we run those separate models, but you don't have to plan for good news. That's something that we look to do. But if the multi doesn't make sense on the acquisition at the basis we're purchasing on a per door basis, strictly as multi, even if there was nothing beyond that and we didn't have a successful exit, then we're not doing the deal. So that's kind of the phase 2, that if it works, great. If it doesn't, it was still a sound multifamily acquisition.
So when I hear that, right, 300 to 2,000, square foot, and you've been in Austin a while, been doing this for, I don't know how many years, does that worry you at all? Or are you just adjusting to the market and you're like, okay, look, it used to be 300, now it's 2,000, but it still makes sense.
It's going nowhere. Austin's going nowhere but up. I mean, Elon was talking the other day, Austin will be what he called a boom town, on Fox News for the next 50 years. We're talking about 186 people a day moving here, and it's been over 10 years that they're moving. The population will double in the next 4 years. The only thing I don't like about the word boom is it insinuates a bust, right? But with companies like Oracle moving their headquarters, Tesla just bought their second land site next to, the first one they bought is very close to 50 acres that we own, that we're building a big industrial development. Phase 1 is about 600,000 feet. Phase 2 is another 3 million square feet. Wow. So all the opportunity zone. And so we're breaking ground on phase 1 of that property this year. And then we have another 320 acres south of that we're building about 1,500 homes, 900 multi-units, commercial, and we're doing it all build for rent. And then let those prices swell, because, I mean, if you try to buy a house in Austin right now, you're literally closing in 24 to 36 hours, no feasibility period, no financing contingencies, and you're paying $50,000 over ask. But again, there's only so much Austin. It's a town, and I can't stress that enough. Outsiders look in here, and it's a simple supply and demand. Supply will run out, and Austin typically is a very liberal city, so zoning is very difficult, and developers usually that becomes very frustrating because you can't cut down trees, and getting through committees and getting through entitlements is very difficult. But if you know how to navigate that system the right way, that's what really drives prices up. Because when supply dwindles, and there's demand, you don't have to be an economist to know that's what makes prices increase. But I assure you, they haven't even been saying the national anthem on Austin. I've heard people say, oh, prices are up, prices, but it's the same conversation about New York. For 30 years, people have saying New York was too high, then every year it goes up. They say, oh, after 9/11, there's no way it'll come back. That was, 20 years ago. And, obviously we had this, big, monstrous blip, if you call it, but then now people are coming back in the city and the prices just keep going up. Condos were 30 grand, they went to 2 million. And, if you look at the data, and, we have a lot of artificial intelligence, a lot of machine learning. We're as much a data analytics company as we are a real estate company. It points nowhere but up. And that's because of the jobs, because of the companies that are signing 30, 40, 50-year leases. Amazon's largest acquisition to date. is still, even after buying MGM last week, is still Whole Foods, for 13.2 billion, which is founded and headquartered in Austin. Facebook's second largest office in the world is here. Oracle's new headquarters is here. Tesla's second largest office is here. There's this little company called Dell that you might have heard of, that employs 164,000 people, is headquartered in North Austin and Round Rock. Apple bought 140 acres that they're building their new site. Google's second largest office in the world is here. These aren't companies that are going anywhere. Google's new, what people think will be their headquarters, is a 1.2 million square foot office building, doesn't even, deliver until 2023. So Apple's new campus won't be fully operational till 2025. Right. So you have at least this 5-year runway before the masses actually come in. So whatever we think prices are today, it's hard to imagine that they go anywhere but up.
So that leads into an interesting point, because I think a lot of people are seeing values go up and up and up. And when you try to underwrite these deals and make sense of the numbers,
sure,
the value you have at the future at a certain cap rate or whatever is so much higher than the market today. You wonder, okay, like, how does that make sense, right? If I'm buying something for $100 today and I'm saying I've got to sell it at 160, but nothing's traded at 160, or you're buying it at 150, you got to sell it at 220, something like that, right? I don't know what the spread is.
Sure.
How do you look at that? Are you buying deals that sell on prices today, or are you saying, hey, look, I just don't even know where it's going to be, so as long as I put in a rough cap rate or exit that I think makes sense, we're just in it for the long run?
No, it's look, you have to look at things in multiple tiers. This is math, right? And so we're very conservative investors. Like, we've been fortunate that, look, you're going for singles and doubles, and every now and then kind of, your hips get around it and it goes over the fence, right? That's really what's happening in Austin. And so we're not targeting these massive double, IRRs, like 20, 30, that's just not our business. Our business is more around capital preservation and being as conservative as possible. So I know that if I buy an old apartment complex that I'm paying, just use a number, $125 a door. Well, if I know that by gut renovating the property down to the studs and delivering effectively a Class A experience, certainly at the interior, and I can increase rents by 25%, right? And then by doing all the deferred maintenance, your expense ratio is decreasing, your rents are going up, you're going to get a healthy spread. Right. And so irrespective of where I think the market is going to go is not how we underwrite or stress test deals. We underwrite it based on growth of NOI. That if I think if I can grow NOI by 25%, just using a number, over the course of 2.5 years, even if cap rates stay static or even expand a little bit, and going into an inflationary period, there is a profitable spread. I don't know exactly what that number is, right? I don't have a magic ball, but we can certainly underwrite, to getting to 10 to 12, 14 IRRs, simply by driving NOI. So irrespective of what the market is going to do, if I increase NOI, cap rates stay static or expand, there's a spread to be made.
Right. Do you find that it's very interesting, because we would go back and forth the conversation of, the individual retail investor versus your more institutional investors.
Sure.
Have you gone that institutional route because of these conversations? Like, these are conversations that we have all the time. This is like very nonchalant, talking high level. And I think people get it. I think people that are in it and understand what they're looking for, this is the conversation that's kind of had. And I'm really happy that we're having it, because I think a lot of people will understand a little bit more. Is that kind of why you've gone that route? Because it's easier to have that conversation of being like, hey, look, this is a good piece of land. This is an area that's going up. Shit, I don't know where it's going, but we're going to increase NOI 25%, like you said.
No,
don't have a number, and it's got to make money, right?
Retail institutional investors, I think retail investors are a lot smarter than people give them credit for. I built the business on retail investors, guys that have been with me for years and years and years. We started out raising 25 grand, and then we have one pension that has 50 million with us, right? We're doing a huge partnership I can't talk about just yet with one of the biggest real estate companies in the world. They both get it. But again, Austin just using, and again, we're not just Austin centric. We're really Sunbelt centric. Like I said, we've invested in 38 cities across the United States and exited successfully in 7 different asset classes. If you look at our audited track record, but right now the bulk of our holdings are in Austin, but it's really a beta trade, right? It's a beta trade against the population migration, against the people that are coming here, against the companies that are coming. And if you buy into that thesis, into that beta trade that Austin is a market that is going to continuously grow based upon the jobs, based upon the companies that are moving here, it's not hard to make that assumption. And both retail and institutional investors appreciate that. But with interest rates being as low as they are, going into an inflationary environment, those are discussions that with the institutions, they really understand, because when you're looking at the stock market trading at, 22 to 23 times PE multiples, you're definitely in the red zone asking for a massive correction. So people are looking to hedge against global risk and at the same time, hedge against inflation. And we know hard assets are a great hedge against inflation. So there's a few things working in our area. So if you go into real estate, expanding your alternative investment kind of, ratio bucket, institutions understand that a little bit better because that's what they're trained to understand. Retail investors understand the beta trade, and they understand, apartments, they understand, rental homes or, houses for sale. And, you can just read the news and see what the surge in pricing is really doing. And, once we kind of hit that inflection point of where we believe that, our investors have done well, we've assessed risk effectively, we kind of turn to sellers. And, the type of offers that we're looking at on our properties right now are just astounding. I mean, like numbers that, the 50 acres that I bought in the OZ, I thought was going to be my 1-year-old daughter's problem, not my, 8-year-old daughter or my 5-year-old son. Certainly, I didn't think it was going to be my problem. It's in between the airport and at the F1 track, and right now, so it was inevitable that part of the city was going to grow. I just had no idea it would accelerate. I didn't know Tesla was going to go right up the street. I didn't know Oracle was going to move, so you don't have to plan for good news. But on the beta side, there's just so many things that are happening that are making the city just, and Texas alone, right? I mean, Texas by itself, it was a country, would be the 8th largest country in the world. It actually just surpassed Brazil last month on a GDP basis. In terms of production. So you're dealing with a totally different animal in Texas and a totally different animal, here in Austin. And that goes for the entire Golden Triangle, whether that's Austin, Houston, or Dallas, and kind of lumping San Antonio in there, still also being a top 15 city.
So it's interesting. You mentioned earlier, you guys are like almost a data company as well. And you've, had quite a lot of information just readily available that you brought out. How have you integrated data into your business, and how has it helped you?
It's in everything. And, we have a new piece of technology that we built called Transparency that's going to roll out in the next 30 days. That's going to bring investor relations into the 21st century of allowing real-time updates. So with the use of Nest Cams, multimedia, videos, investors will be able to log into a fully encrypted app that we're going to actually white label and bring to market. I built it for us, though, ultimately, that they'll be able to log into the app and look at the renovations in real time. Like literally log in and see the property, see people working, see what they're doing, and then interview asset managers, property managers, because we're vertically and horizontally integrated. We have contractors all the way through property management, all the way through PE, all under one umbrella. And so if you look at our individual units, we quite literally know if you turn on your microwave, and we know how much wattage you're using, which helps us make the better investment decisions. It's such a massive amount of data that we're now bringing in data scientists and bringing other people to help us understand how many cars drive by the property every day. We're tracking, geofencing the units, to deliver a better end user experience, and, through the use of surveys, the use of understanding the energy usage on a unit by unit basis, it has helped us really make better investment decisions using machine learning and AI to understand where these population migration trends are going, so we can kind of skate to where the puck is going, as Gretzky would say. And it helps us build a pretty big business.
Mm-hmm. So I'm curious, right? Because, I recently started my own thing, very small, and I love all the stuff you're doing. How were you able to kind of scale up from, like you're saying, doing, I think, single family developments to, now doing all the stuff where, there's a ton of people that develop, but I doubt there's a ton of people doing the data side that you guys are doing. What do you think has helped you, get to where you've gotten so far and, continue to go?
Pain. Excruciating amounts of pain. And it's input and output, right? I mean, I haven't been on a vacation in 20 years, right? I mean, when you work 18-hour days, 7 days a week for 20 years, there you have it. And most people aren't willing to do it. And that's fine. Actually, y'all should pick up this book. And I'm a voracious reader. I was an English major in undergrad, and both my parents were big readers. But Tim Grover's new book called Winning, his first book was called Relentless. I highly recommend everybody read it. My book comes out this summer called The Gift of Failure. And it's about just relentless, merciless, brutal grit, and having a why. Having a real why, and not to be cheesy and go into that Simon Sinek, kind of world, which I love Simon. He's a beautiful soul. And, but I knew what I was going to do. I knew why I wanted to do it. I wanted to create a better user experience on the single family housing side, being that it was in the DNA of what we did early on. We believe in what we're calling futuristic suburbanism of, what does that mean? Because I'm a millennial. I'm under 40. So thinking of what's Gen Z really want, what do millennials really want? Where are they going to be? What are their core values? And once we kind of got a good grasp on what that was, or what we believe it to be, and stress test it, it's something that's important. It's important and something we believe in. But at the end of the day, you can see Elon talk about it. If you're working 40 hours a week, for 10 years, that'll get you somewhere. But if you're working 120 hours a week, that's 30 years, not counting the compounded experience, the compounded growth, the compounded ability to scale. But I wish I could tell you there was a magic formula, but just, there's probably not a week goes by that I don't sleep in my office at least one night a week. And anyone that knows me knows that working hard is the understatement of the century.
I love that. When you look at different asset classes, I think a lot of people always say, like, stick to one, know what you know, and really scale up from there. Why have you gone into different asset classes, and what do you say to kind of that thesis?
I think to each their own. I think there's merits on both sides. I think, finding a single asset class that you really understand and just becoming a master of it, or the jack of all trades is the master of none, or, whatever cliche you want to use. I believed in Austin, and I believe that there's merit in each one of those asset classes. So if I look at the best in class operators in the world, whether that's Related Group or Starwood or Tishman Speyer or whatever, SL Green, whatever company, massive companies you want to look at, a lot of them have found expertise in certain asset classes. So that cued me to say, okay, well, if some of these groups have become experts in office and there's growth there in office and they're still buying, or this group is experts in industrial, or whatever you want to pick, led me to believe, say, okay, if I can make micro investments in those asset classes, begin to put them apart, build teams around them, build systems around them, over the course of 20 or 30 years, because I'm on my 1-year-old's timeline. I have everything that I need in this world. I'm a simple dude, man. Like I have everything that I'd ever want in this world. My parents were immigrants. I had a speech impediment growing up. I still pinch myself every day that this is the life I'm able to live. I have everything that I want materialistically, if that makes sense. Like this is my life's work. Like it's not what I do, it's who I am, right? And that's really, really the truth, truly. And so I wanted to understand how I could deliver a better retail experience, whether that's creating an immersive retail experience, marrying pop culture, with real estate. What does that mean? And as in a growing city like Austin that I love so much, you have to have logistics. So to understand multifamily and housing, you have to understand the logistical backbone that's going to support that. So all of these asset classes actually have a golden thread between them. And once you begin to understand holistically what that means, it becomes a lot easier to dissect the intricacies of what those asset classes actually are. And we're very passionate about holistically understanding what that is. So if you understand industrial and the workers, where's that workforce housing going to live, and how is that going to be supported? That marries into the master plan developments or the apartment side of the business. Or okay, where's that person that lives in your apartment going to eat? Okay, that marries into retail, right? And if you follow the rabbit hole, there's that golden thread that unites them all together. And it's all about building teams of experts around those asset classes to be able to execute properly and stress testing them appropriately. But we are very much in the real estate business as much as we are in the data business, and that's a big word. That's a big word, but we take a lot of enjoyment in understanding the full spectrum of what that means, and that's why we kind of went into all of them.
So was that something you just took a stab at early on and said, hey, we figured out one way or another, or you built it on later that had the experience?
No, what we did was we went to best in class operators at the beginning. And so when I say we, it was just me in a 100 square foot office, probably smaller than the office. That area that I can see where you're sitting right now is probably the size of my whole office. And, raising the money, writing the documents, handling all the stuff. Now we have third-party fund administrators and auditors, and sometimes I feel like I'm running an accounting firm, but it's another discussion. But at first, to mitigate risk, because at the end of the day, we're risk managers. That's what we really do. But, oh, you're an investor, you're a real estate, whatever. You hear all these words. I found out the other day I'm a real estate tycoon, apparently. I don't even know what that really means, but but at the end of the day, I'm a risk manager, right? And so ultimately, understanding that risk, assessing that risk, and understanding the markets that you're going into, taking your ego out of the equation, and making good investment decisions. What led us to that was going to best in class operators who were in these different asset classes. So when we were in these 38 cities, these 7 different asset classes, it was finding what we believe to be a best in class operator in that given market or in that given asset class, and being co-GP capital, LP capital, lending against it. We played all up and down the capital stack over the years and learning from them and learning what they did. And then once we felt like we'd extrapolated enough, our investors had done well, we'd learned some stuff, maybe things we can improve on, things that we can replicate. It was only then that we started owner operating, after we had spent several years investing alongside best-in-class operators in each one of the asset classes.
So did you guys start more as just raising capital for other deals exclusively, or was that you added that on to?
No, that was how we started. I was on Wall Street for many years and had some great relationships, not only with institutions, but with a bunch of high net worth folks that knew I was kind of the one crunching the numbers and doing the work. And they followed us, and had the blessing of all my bosses who are now all my LPs. They've stuck with us, and now their kids work for me. And, quite literally, 3 of my closest mentors, their kids all work for me. Right. So we kind of live by those old school rules of, passing down that apprenticeship. But yeah, it was around just placing capital and being a good steward of capital. And our investors believed in that early on. And, I don't think they were really too concerned of where the alpha was coming from, as long as, we were at the helm of it and we were underwriting the deals. And And we did that, and we exited all those positions accretively and transitioned into being owner operators. And like I said, being vertically and horizontally integrated.
Mm-hmm. Gotcha. And just, with COVID kind of now settling down and a lot of things more opening up, do you see any potential trends going forward that you guys are going to look to capitalize on?
Yeah, the population migration trends. I mean, it's that simple. You're looking at a systemic shift, and people leaving the East and West Coast, moving into the Sun Belt, and it's systemic. It's not going to change, and this has been happening for 12 years, 14 years, right? This is not new. COVID accelerated it dramatically and made it a lot more, I guess, visible, so to speak, where you look at the population migration in San Francisco, it literally is nosediving, but it's been like a steady kind of drop like this. New York has been kind of steady drop. Now it's dropping off a cliff. And where are they going? The East Coast is migrating into Florida, migrating into Nashville, and New York and Florida have always had a great relationship. And then the California and the Illinois of the world migrating into Texas. And if you look at the economies at a macro level of, Illinois, California, and New York, these are bankrupt economies. They have, large, top line revenue, if you would, but they don't have any money. We operated a $12 billion surplus and have no state income taxes, in a fully diversified economy. And so it's no accident that they're coming in here, and from a geographic standpoint, being right in the center of the United States. Again, the confluence of all these events are leading to something that we'll look back 30 years from now and see something really, really special that that our investors will benefit from.
Love it. Is there anything, do you have any opinion on like the work from home stuff? Are you guys, as you guys are developing, are you looking to incorporate that more into, especially into the multifamily world of having space for that? Or you think
we've adjusted to it. So we've built some in our multifamily redevelopments and renovations areas, for outdoor seating, bringing in, high quality Wi-Fi internet that services the entire building, that if people want to work from home. But, look, we as people are tribal beings. It's work from home on a majority basis is bullshit. I mean, nobody's going to work from home, long term. Jamie Dimon has been very vocal about it. David Solomon at Goldman Sachs has been very vocal about it. Productivity has plummeted. And, the mental health trauma that people have endured of not having human interaction is just unsustainable. I mean, it's just completely unsustainable. People want to be out of the house. They want to be in the office. They want to see their clients. Are there going to be a faction of workers that are like software engineers or non-client facing individuals that can work from home permanently, so to speak? Sure. But anybody that's client facing, and even those folks, are going to have the optionality. But again, that's not new either. The CEO of Coca-Cola, when he took over, I want to say 12 or 15 years ago, he had allowed work from home for a lot of, factions of the business and lowered their office footprint. But now we have more startups than we ever have in the history of America that are filling that office space. And so I'm still very bullish on office. People are going to go back to work, no question. And they're dying to. There's so much pent up demand that I think you're going to see a massive, massive K-shaped recovery through hospitality, through retail. People want to go out and have a beer with their friends. People want to go back to concerts. They want to go to the movies. They want to go to Disney World, on a big scale. Individuals, they want to travel, get back on airplanes and go see their clients in XYZ city. And they miss their friends at the office, like going out, breaking bread, having lunch, hanging out, whiteboarding, harboring new creativity. This is just who we are as a race, and as a species is probably a better word. And that ain't changing.
Well, I was in Nashville 3 weeks ago when they lifted the ban. Yeah. Just for like a conference and just seeing a buddy, and literally the week and they lifted the ban, the place was just packed full. Like just the downtown strip was crazy.
Austin's the same way. Memorial Day this past weekend was just booming, and the excitement and the exhilaration that you saw amongst people, and you could just see the happiness around hanging with people not wearing masks as much. And obviously the COVID numbers going down tremendously. COVID's here to stay. Anybody who thinks COVID's going away, it just doesn't make sense. It's going to become like the flu. There's going to be waves of it. It's going to come. Hopefully people are vaccinated. if they're in that high risk kind of tier. And we know what that is: people that are morbidly obese, the elderly, that have underlying health issues. And the world's going to open back up. This is, Mark Twain used to say that history doesn't repeat itself, but it sure does rhyme. This wasn't the Spanish flu. This wasn't 1921. But if you look at 1921 to now, you're saying we didn't grow, we didn't come through it. We saw a Great Depression after the Spanish flu and still recovered massively. And, we saw world wars happen after that and still huge recovery, right? Look at a before and after picture of Tokyo, but over the last 50 years, and this is after a pandemic that makes this one look like, and look, my heart and soul goes out to all the people that suffered from COVID directly or indirectly. And not to be insensitive, but, as an investor, we're going to look back on this on the 10-year and it'll just be a blip in the road. On an investment basis. The mental health tolls and the other things that go along with it, I'm probably not qualified to speak about those, but I think they're being underappreciated, of how difficult this has been for a lot of people, for the children, the learning curves for the younger children of not being in the classroom. So much of our social skills are learned as children on the playground, interacting with, having human interaction. But from an investment standpoint, on the 10-year, it doesn't even rival 2008. This is, and then we're talking about coming into an inflationary environment. We've been asking for inflation to happen for 8-9 years. This bull market has been sustained, not because of fundamentals. Let's put it that way.
Do you have any, I've seen more and more reporting of, the institutional buying of single family homes, right? And eventually as the eviction moratorium, we're capitalizing on it. Yeah. And the eviction, the foreclosure moratorium lifts, there's going to be a lot of it. Do you see when that lift comes, it dramatically impacting the landscape of, the single family landscape across the country? Single family and apartments.
Because, the eviction or foreclosure moratorium lifts June 1st today in Texas. So there's going to be, I think it's going to have a massive, massive effect. And a statistic that I think is really understated is that individuals aged 18 to 29, 54% of them are living at home. So that's shadow demand. That's pent up shadow demand. So when those kids, leave the house, you think they're going to high rises in downtown, or are they going to single family rentals in the suburbs? Are they going to vintage apartments? Are they going, we call it the $5 Uber ride. So if you're within a $5 Uber ride of all the fun stuff, that's where folks are going to go, which has made us very bullish on this older multifamily type product that can be renovated and rented at a fraction of what new development is. But I'm extremely optimistic of what the future is going to hold. And that's based on data. That's based on the science. That's not just my, individual belief, so to speak. The numbers point to it. So when you have 54% of one of the largest demographics, if not the largest demographic in the United States, living at home, when that market re-enters the workforce and re-enters, the economy, so to speak, it's going to be massive.
100%. No, I think that makes a ton of sense, but I think that's also a really great place to wrap up. So Ari, thank you so much for coming on, sharing all your thoughts, opinions, expertise. If people want to learn more about you, connect with you, follow you, where can they do all that?
Yeah, you can just go to rastegarproperty.com or, on Instagram at Rastegar. If you want to find me, it's pretty easy. We've been in Forbes, the Wall Street Journal, Commercial Observer, does their Power 100 every year that I'm sure you all know. I came in at 93 this year. If you want to find me, it's not that hard. You can type in just Rastegar into Google, and I think it'd be pretty easy to find me if you really wanted to.
Perfect. Guys, definitely go check them out and hit up all their stuff. But thank you everybody so much for listening to this episode of the podcast. If you are not already subscribed, it would mean the world to John and I if you would do so. And if you are, please send it to someone that would get a tremendous amount of value from this episode. Ari, once again, thank you so much for coming on, man. This is great.
Thanks for having me.